It is Monday, 6/26/2017. It is 8 p.m. Pacific Standard Time, so you know what time it is. It's time for a little bit of coin metal. And oh my goodness, it was certainly a productive get your ass kicked at Jiu-Jitsu Monday, but I was getting my ass kicked well before I left the house. Man, what a sell-off today. Whew. And, I was thinking about this earlier, and I had talked to one of my friends about this, and it dawned on me right off the bat what precipitated it. And I could guarantee you right now, the biggest sellers today were institutionals that were legacy finance. How do we know? Because they waited until Monday. That's right, folks, Monday. And who else starts their work week on Monday? That's right, legacy finance and everybody else that's not in crypto running 24/7, 365. Because that's just the way crypto rolls, people. And so, yeah, the big-ass sell-off, most likely a bunch of people that were really staking on that whole segregated witness business. Either that or they're selling ahead of it to try and get all their blocks marked as BIP 148, in which case they can go fuck themselves too. I don't like that shit. And, if it happens, it happens. I actually saw something on Twitter today. Somebody said that Bitcoin splitting might be the best thing that happened to it. And I said, it might not be the best thing that happened to it, but it might get rid of a few of the bankers that have been trying to infest our ranks. Anyway, I'm going to go ahead and break out with the first dance, and because it just seems so appropriate, especially for us hodlers, Wait and Bleed by Slipknot, here on Coin Metal. And that was Slayer with Seasons in the Abyss, because, I felt a little winter today, when Verge took a major dive today. It seemed to recover a good portion of the progress that we have made so far, back up there around 125, I believe, the last time I checked. But it's funny is a lot of crypto took a major shit today. I mean, like a lot of it, and there were all kinds of rumors as to why. Personally, I think that the people that have wanted segregated witness, they've been holding on to masses of Bitcoin, and they've been slowly accumulating them, hoping that they would get their segregated witness in, and then they would be able to do all this ICO bullshit with their Bitcoin, except for on Bitcoin instead of Ethereum. See, I think that the whole ICO rush, it was supposed to happen on Bitcoin with side chains. If you guys remember about 2 years ago, roughly around when that whole segregated witness kind of thing started bubbling up and scaling issues started being entertained, or scaling options back then. You'll notice the vernacular has changed quite a bit, and it's a bit more of that vocabulary creep. I think I had mentioned that before with the creep from minor donation to minor fee from minor donation to minor tip to minor fee to transaction fee. These are all mimetic drifts, and if you think about the implications of each as it evolved, they were divided further and further and further away from this idea of minors. Because for the first half it was minor donation and minor fee, right? So anyway, there's some people that still refer to it as minor fee. Point I was getting at is that I believe that Bitcoin was supposed to have had this hard fork event thing that they're trying to get to happen on August 1st. I think it was supposed to have already happened in Bitcoin. And it's just pissed them off to no end that even though they haven't gotten their scaling option in, Bitcoin has still gone up in value. Now, some people are looking at the price dive that we had today and the other day and trying to say that, oh, you know, this is some lack of confidence in Bitcoin or whatever. But, you know, the fact of the matter is we just had a major fucking hiccup on the goddamn Ethereum network with a flash crash. I don't even know that they've sorted that whole thing out yet. I mean, I think for the most part, what is it, BTCE or one of those other, two of the exchanges are like going to comp their users. And that's, honestly, I think it's not a good precedent, only because it incentivizes people to make those kind of mistakes again. It's like, oh, well, you know, if we eat shit tomorrow, it's okay. The exchange is going to help us out again. They're going to reverse the transactions. They're going to give me my money back. Somebody got rich and somebody lost some money. Okay? And I'm sure that the people that got rich out of it, they did not give the money back. You know, the exchange took that out of their own ass, or is going to take it out of their own ass, or going to figure out a way to negotiate it back in, or whatever. Like the what do you call it? BFX token from Bitfinex. Honestly, I think that was a decent way to go about it. Although I think that I should have gotten more BFX coins because I had a decent amount of Bitcoin on there. And I feel that at the time I liquidated, I shouldn't have liquidated when I did. I probably would have been made whole and then some by the end of it. But, you know, hindsight is always 20/20, man. And we make mistakes to learn. You know, now the trick is to learn from the mistake and not keep repeating it over and over and over again. Which for some reason I haven't quite gotten that in trading yet. But one of these days I'm going to be a competent trader. I'm going to kick all your asses. But it hasn't happened yet. I never claimed to be a big trader or anything like that. I just, you know, I've been in it for a little while and seen quite a bit of things go on as far as like the release of new innovation and whatnot. And it does seem to be cyclical. And, you know, that like you'll have a new medium of exchange, and then you'll have a flurry of activity afterward, like similar projects to it, and then like 90% of them will fizzle out, and there'll be like one or two left that were actually worth the shit to begin with, and that had competent people behind it and people that believed in it. You know, and with regard to ICOs, I think that they're an attempt to synthesize the organic growth of like Bitcoin and Dogecoin and of course Verge and a few others, where there was a diehard community that came in, was dedicated to what it is, you know, the ethos behind the coin, and is still there. And, you know, the rest of the shit is just flash in a pan. And I don't know that Ethereum is I don't know. I don't know what Ethereum is. Initially I called it a scam platform. And so far it's living up to that moniker. I mean, but I don't blame Vitalik for that, really. I don't. But the part that I do blame him on is that he left in, I think, a little bit too much autonomy with how to set these things up. And, you know, things like there's shit in those smart contracts. I did a whole episode on smart contract stuff last week. If you want to check that out, that is up on my YouTube channel. And one of these days I'm going to add a video element to this. But anyway, point being that there are aspects of the ICOs where I think that they have probably too much control over the assets themselves, and I saw and see too much potential for abuse in it. You know, I mean, it's great to be Janet Yellen, but be Janet Yellen on your own coin rather than, you know, be Janet Yellen, create a coin that you don't ever fucking intend to like fulfill on. That maybe you've got some spaghetti code, maybe you've got a decent white paper, you don't have an office yet, you're working out of your bedroom, and where you don't have but like 4 people as your quote-unquote community, and you don't ever intend to fulfill on your stated goals. Because we find this happening over and over and over again, where the ICO will happen, and then we see a liquidation immediately of some of the Ethereum, and we've been seeing several of them. And they do need operations and whatnot, but you don't need to liquidate $30 million worth of this shit to fucking run ops. I mean, I think there's going to be some boats and hoes involved at $30 million. I'm sorry. And maybe a big pile of cocaine or something like that, or some raves. Maybe I'll be going to Burning Man. Or maybe that is to pay for your Burning Man project. I don't know. All I know is that you don't need to be liquidating that much funds at once. You need to be liquidating like $5,000-$10,000 a month. And you know, I mean, that's assuming that your number of people is as finite as I think they are. I don't know. There are a few ICO projects that I see that look like they're an actual project, like Sonam. I checked out some presentation on Sonam today, and it looked kind of interesting, but I'll have to investigate further to figure out exactly what the fuck makes Sonam so wonderful, and why I shouldn't just throw my money into Bitcoin. But anyway, there's all these rumors and whatnot as far as like what's going on with, you know, why the price of Bitcoin, why the price of Ethereum are crashing so hard. And like I said, I think that there are institutional traders that have been holding on to these coins, and they're seeing which way the wind is blowing, and they're seeing that segregated witness, even the promises of it, the fucking NWA or NYA or whatever the fuck that is, that it's just signaling an intent to support, not an actual, you know, not an actual we're flagging support for segregated witness BIP9 or BIP whatever. And I think that's kind of becoming apparent to people, and so they're getting weak hands. You know, they're shedding themselves of their Bitcoin because they need to move that fucking liquidity somewhere else. They need to open it up so they can take care of fucking ops elsewhere. You know, it's a simple enough explanation. You know, it can see the coercion mentality behind BIP 148 doesn't really play well with people that came into this space because it was free and open, not because there was a fucking gun to their head to make an upgrade or an update that they don't feel is an update or an upgrade. You know, I mean, I'm pretty sure I got into this space for the freedom part of it, not the gun to the head kind of thing. Yeah, I mean, there are certain things for the health of the network that need to be addressed and whatnot, but there are other things that don't need to be added to the network that are already being facilitated by other projects. we can see that Ethereum has plenty of ICOs all over it. It can do little payment channel tokenization bullshit. It's got the transaction throughput. Fuck, look at Ripple. That's got the transaction throughput. That's got your 40,000 transactions per second. You know? But more importantly, Visa's got 40,000 transactions per second. If you really need to do 40,000 transactions per second, there you go. They've got a mutable blockchain and everything. You know, you can fuck up on that network and somebody will cover you. They'll wave a magic wand and whip some more tokens up. You know, as some of these ICOs can do, by the way, which we covered in that other episode. But the point being that there are already solutions out there for you that follow these rules that you're trying to impose on Bitcoin. And, you know, I mean, if it's already available, why try and tweak another tool to do what you wanted to do those same fucking things? I mean, what advantage does it confer to anybody then? It doesn't. You know, if I want to work in a network that I have absolutely no control of my funds over, then I'll go back to Visa. I'll just put my funds on my Visa card instead of trying to buy Bitcoin with them. Anywho, so one of the rumors that I found very, very entertaining with why there's been such a precipitous crash was this one, Proof of Life, and this is on, what is this, QZ.com. Fake news of a fatal car crash wiped out $4 billion in Ethereum's market value yesterday. And this is on Quartz, I guess. And let's see here, written by Jun Ian Wong. Oh man, no picture! Can't tell if this person has a penis. Sorry. I don't know if June is a male or female name specifically. My apologies if it is. No identification of whether a penis exists. Anyway, here we go. Vitalik Buterin confirmed dead. Insiders unloading Ethereum read the title of the post, and we're definitely going to click on that. On 4chan, the notorious online message board frequented by internet trolls. Fatal car crash, it went on. Now we have our answer. He was the glue. Ethereum, or ETH, refers to Ethereum, the world's second most valuable cryptocurrency, which was invented by a 21-year-old Vitalik Buterin in 2015. The currency's price has risen by 50 times this year so far, and many market watchers have wondered when the gains would stop. The price was already in the midst of a sudden decline yesterday that saw about $4 billion wiped off its total market value. And according to the Post, Buterin's untimely death explained it and heralded a crash. It turns out that Buterin wasn't dead, nor involved in a car crash. He took to Twitter to prove that all was well, but how to supply evidence that he was indeed behind the Twitter account. In the cryptocurrency equivalent of posing with the day's newspaper, he scrawled out some data linked to the latest block. You can see that data for yourself here, mined on the Ethereum blockchain on a piece of paper, and took a selfie with it. WikiLeaks founder Julian Assange did something similar to dispel rumors of his demise by reading out data from the Bitcoin blockchain on a live stream in January. Buterin then posted the selfie on Twitter. And here it is. Another day, another blockchain use case, says Vitalik. Ethereum's slide seemed to hit a bottom after the hoax was posted on 4chan, recovering about 10%. Despite yesterday's steep sell-off, it still traded 39 times higher than it was at the start of the year. This is what market manipulation looks like in the age of cryptocurrencies and fake news. The hoax did reveal something interesting about cryptocurrencies. Unlike Bitcoin's creator Satoshi Nakamoto, an almost mythical figure whose identity remains unknown, Buterin is the de facto public face of Ethereum. He doesn't control the network. It's a piece of decentralized software that anyone can run or build on, just like Bitcoin. But his status as its creator means that rumors like this one have a higher chance of taking hold in the markets. That means that $26 billion in market value partly depends on a 23-year-old staying healthy and alive, and providing selfies to prove it. Oh, man. Well, as we've discussed previously, today, there are certainly other explanations at play with regard to the dip in the Ethereum price. My apologies, it's a terribly hot day, and I did not hydrate very well during jiu-jitsu today, so, Anyway, it's funny, it shows a little graph here for the Ethereum price, June 25th to 26th, and there it is, man, that deep V. Yeah. Well, I'm sure that Ethereum is not done having such events. I think the more there are these little ICO things popping up on it, and the more that there's the potential for precipitous sell-offs of Ethereum for guys who want boats and hoes. Yeah, like I said, my initial feeling was it was a scam platform, and so far it's kind of playing out to be that. I mean, there are legitimate projects on it. I'm not going to deny that. And there are some that are actually, I guess, making money. I don't know. I haven't investigated far enough into that. Maybe that would bear some investigation today, or not necessarily today. Maybe Wednesday. But we're going through an interesting phase with regard to Ethereum, and I think that we're going to see more of the mistakes that people want to make in Bitcoin made in Ethereum first. And I think that's a fortunate thing, and hopefully Bitcoin will stay such a project that it initially was, or maybe could revert to that now that there are other places where all the wonderful little scaling solutions can be applied. But I don't know. I'm sure there will be changes to Bitcoin in the future that I don't know that they would look objectionable to us now or then. I don't know. I'm sure there will be some change. Change happens. The network has to adapt because the attackers are adapting. And I've talked about this before on the show, but I really think that some of Ethereum's problem is the congestion of their network, and that was brought on by the split from Ethereum Classic. Now, you know that at least 51% of the network bailed, because that's what's necessary in order to have a hard fork like that and split and have two chains. So I would suggest that is a lesson in what happens when you try to impose on the network changes in the protocol that the majority of the miners do not agree with. Okay? We've seen it. We've seen what it looks like. We're watching it in real time between Ethereum and Ethereum Classic. So we can consider that kind of like a lesson learned kind of thing, you know? That a segment of the quote-unquote community... Who's the fucking community? Anyway, a segment of the community thinking that they are more important, or that the changes they want to impose on the network are more important than the vast majority of the rest of those people that represent the consensus. You know, like I said, we've seen it. That's what it looks like. It looks just like this. It looks like you have a one coin that is adhering to the values of the initial coin that started off. So, you know, you'll have a Bitcoin that operates on the principles that were originally intended, and they'll probably get their block increase without the segregated witness bullshit. And then you'll have the other coin that does have the segregated witness and the Lightning networks and all that other business. But that one is going to have major network congestion. It's going to get hacked fucking constantly, at least for the first year, until they get their sea legs or whatever. And if they can survive their first year, they'll have a legit coin for the most part. But they'll be in the same position with that Ethereum's in, where, you know, you've got one person or a group of people that are recognized as the quote-unquote top, whereas you will have the other network, which will be just a bunch of miners and exchanges and whatnot that are working together. And I think that one will actually be better because it won't have all the legal bullshit fitting onto it. You know, you'll be able to mine without needing a fucking FinCEN license, because you're not running a Lightning network where you've got custody of people's funds for 2,000 blocks worth of block time, and, you know, their transactions are at your whim, and they'll probably have some sort of design in there similar to that ICO that we were talking about the other day, where it has some sort of function in there where they can just like snatch your coins. I mean, come on now. I think that was Bancor, as a matter of fact. You know, I'm pretty sure that's always been like an intended protocol, and they latched it onto Ethereum because they couldn't get it onto fucking Bitcoin, because the majority of the miners didn't want it, and still don't. And I really hope that there is a chain split, because I don't like the direction of segregated witness and Lightning networks. I see in that all of the fucking hallmarks of going right back to centralization and right back to trust. Like, give you just an example of what I mean by trust. And this isn't FUD or anything like this. This is according to their own paperwork for Lightning Network. Okay, they say that 1,000 blocks, and I've said this before, that it's 8 business days, or roughly thereabouts. So, before, you had to quote-unquote trust the network for maybe 10 minutes or so. You know, because there were congestion points and whatnot, and there still are. You know, every once in a while there's a little congestion on the network. But if you've applied the appropriate fee, of course, your shit will go through. All right? I haven't had too much trouble with getting transactions to go through. But anyway, on the Lightning Network, it won't touch back to the Bitcoin blockchain for however many blocks the fucking the payment channel is open for. So if it's open for 1,000 blocks, your funds are bouncing around on the fucking Lightning Network for 1,000 blocks. That means that the nodes on that network are now custodians of your funds, because the state of the funds is in their hands. Now, I've said this a million times, and especially on my Twitter feed, I've said it a million times to people, that this changes the definition of a miner if they're on a lightning network to fit the legal definition of a quote-unquote custodian. And, of course, it depends on the jurisdiction we're talking about here. And also a money transmitter. Because the final state of the funds is established by you. When you touch back to the Bitcoin blockchain after those 1,000 blocks, you're transmitting out to the network the state of the funds. Whereas before, that was just an intrinsic part of the process. It's like, hey man, we're just putting the transactions through on a best fit basis. So, we're not discriminating the funds. We're not discriminating based on addresses or whatnot. If they fucking line up with what we've got on the books, it's good to go. If it passes 6 confirmations down, it's golden. But that's not the case with this fucking Lightning Network business. That shit just bounces around for fucking 1,000 blocks. You're trusting that at the end of 8 days, that shit's going to touch back down to the Bitcoin blockchain, and the state of your funds will be what you'd anticipated when you actually perform the transaction. That's back to trust. You only have to trust a bank 3 to 5 business days now. You're going to have to trust your bank for 8 business days with this fucking Lightning Network bullshit. Anyway, I think I've beaten that horse completely fucking dead and raw. So let's go ahead and touch back into some music. And what to put on. I haven't played Manitou in like forever. I'm feeling the need. Venom, Manitou, here on Coin Metal. And that was Transfiction by Meshuggah. Hoy. Anywho, yeah, man, they tore the crap out of my arm the other day. Anyway, we were on Ethereum's case, because, man, it has been Lamboland Lost for them. And so much so that CNBC even caught up on it. And this one was written by Evelyn Chang, no penis. Ethereum is crashing by 20% right now after confidence in Bitcoin rival shaken. Bitcoin rival Ethereum plunged Monday despite a major exchange's effort to shore up confidence by announcing a credit for customers who lost money during last week's flash crash. Ethereum, also known as Ether, traded 20.9% lower at $239.63 Monday afternoon, according to CoinDesk. Last Wednesday, Ethereum briefly plunged in a flash crash from above $300 to 10 cents on Coinbase's GDAX exchange. On Friday, the exchange said it would credit customers who experienced a margin call or stop-loss order on GDAX during the flash crash. GDAX reported Monday afternoon Eastern Time, a temporary halt in trading for all products, which was resolved within an hour. Ethereum one day oh damn, holy crap! What's funny about this is they include that chart that we were looking at with the previous article, but they add like another, I don't know, maybe 3 or 4 hours worth of trading, and it levels out for just a moment. Like it picks back up, and then it tanks really hard, and then it levels out for a moment, and then it tanks harder again. Oh wow, that's tough. Let's see here. Ethereum is still up about 2% for June, and at 2,500% for the year, according to CoinDesk data. At its peak, Ethereum had surged more than 4,000% for the year. An unsubstantiated rumor Sunday that Ethereum's founder Vitalik Buterin had died also reportedly hit Ethereum's price for a brief period. Ethereum fell from around $329 to a low of $284 Sunday before recovering, according to CoinDesk. Buterin tweeted a picture of himself Sunday evening Eastern Time to dispel the rumor. And yeah, we saw that. William Morgayer is author of The Business Blockchain, Promise, Practice, and Application of the Next Internet Technology. You got to turn that down just a tad. Let's see, here it is. The Business Blockchain, Promise, Practice, and Application of the Next Internet Technology said he did not believe the rumor was the main factor behind Ethereum's decline. We need to see a full 24-hour cycle in order to fully assess what is actually happening, he said in an email to CNBC. These cryptocurrencies are traded globally, especially with the large amount of activity coming from China. So I'm waiting to see what happens around 6 p.m. Eastern Standard Time this evening. Or 6 p.m., my apologies. Digital currency investors also pointed to the reversal of last week's exuberance stemming from the launch of several Ethereum-based projects, which ended up clogging up the network. The inability of Ethereum to handle the orders raised worries that digital currency may soon face a debate over an upgrade model similar to a heated controversy over Bitcoin's future that has weighed on that currency. Two different methods for upgrading Bitcoin, segregated witness. No, they're the same fucking thing. Fuck you, fuck you, fuck you. Trying to say that segregated witness 2x and BIP 148, no, they're not two options. They're the same fucking thing. Are set to go into effect July 21st and August 1st, respectively. Initially, the systems were incompatible, threatening to split Bitcoin in two and likely reducing its value. However, a developer announced earlier this month a way to make the two methods compatible, helping Bitcoin recover from the lows. Helping Bitcoin to recover from lows of the month, and they didn't actually include a fucking link for that. But helping Bitcoin recover. I don't know. I'm going to touch on that article next. Bitcoin traded nearly 5% lower on Monday, around 2452, still up about 5% for the month and 153% higher for the year, according to CoinDesk. In a blog post Monday, digital currency investor and Union Square Ventures partner Fred Wilson said the decline in Ethereum was profit-taking after a massive run higher in the last 6 months. My gut says we are headed for a sell-off in the crypto sector, he said in the post, but he said he remains optimistic about the future of cryptocurrencies over the next 5 to 10 years. And I do too. All right. Wait, what's this? Buyers beware lessons on CNBC. Anyway, I was just looking at this, the bullet points from this article, and this one was actually attached to the previous article, but it's by Evelyn. This one is by Evelyn Cheng. And it was written on Saturday the 17th. I don't know if that's considered old news, do you think?
This week's flash.
Oh, no. Fuck you, die. Alright, never mind. We're done with CNBC and your fucking preloading bullshit. I hate that. We lived through that. That was like 97 and 99 with auto fucking opening pop-ups and shit. And we got rid of that crap. And we agreed that was fucked up. Now stop doing that shit. It's fucked up. I mean, it was worse before because the tab that you had open that had whatever it was playing on it didn't have the little speaker thing to tell you which one it was. And actually, we didn't even have tabbed browsing back then. You had like 4 or 5 windows open. Anyway, when I think about the crash, I think that this dude's right that there's going to be additional sell-offs. But I think it's going to be from the ICOs. I think they're going to start needing additional money for boats and hoes and coke. And, that shit costs money, man. You gotta liquidate some ether and make it into dollars or yen or whatever the fuck your ICO is in. Actually, I don't think most ICOs are quote unquote in the United States. I know that a lot of them aren't. Like Bancor, I don't think that one's in the United States. Although I could be mistaken. Anyway, if you haven't read the information on Bancor and you're invested in Bancor, you might want to divest yourself because I see a lot of potential for fuckery with that one. But that's just my opinion. That is not an instruction to adhere to me or anything like that. Do what you want with your own money. If you see some value in it, wonderful. But honestly, I've been reading paperwork on coins and whatnot for quite a while. And like I said, I've read not only the paperwork for Bancor on here, but also people's commentary on it that was a bit more technical than I could provide myself. And from everything I've read so far, I'm pretty convinced that it's got a lot of scam-maliciousness to it. And there are certainly a lot more reliable, a lot more established coins and coin projects than that business. Anyway, I wanted to get in this one because anytime I see that a legacy person is positive about Bitcoin, I always get a little leery about it. Anyway, here it is. Barclays positive about Bitcoin, holds talks with regulators. And regulators, our two favorite groups getting together, bankers and regulators, right? And this is by Gautam, I guess. And this is from Bitcoin News. Written 9:30 p.m. June 26, 2017. That's kind of weird. Must have been Eastern Standard Time. Anyway, here it is. Barclays, the UK banking giant, is interacting with regulators to incorporate Bitcoin and other cryptocurrencies into its operations. Read more. The banking industry's interest in cryptocurrencies stretches beyond just blockchain technology. Barclays, the UK-based banking giant, has made it evident in its recent interactions with the country's regulatory body, the Financial Conduct Authority, FCA. According to reports on various news outlets, which we will click on that link because we will probably follow it up. On various news outlets, the discussion between Barclays, regulators, and other fintech firms has got something to do with bringing Bitcoin and other cryptocurrencies, quote-unquote, into play. The information was provided by the CEO of Barclays UK, Ashok Vaswani, while speaking to the media. However, he stopped short of providing more details about the use cases the banking institution is interested in implementing to its existing and or new banking and financial solutions. The meeting was part of an effort to discuss the legal implications of cryptocurrency use and steps that can be taken to make it comfortable and safe for the licensed mainstream financial institutions to use cryptocurrencies. Vaswani was quoted in the media saying, quote, "We have been talking to a couple of fintechs and have actually gone with the fintechs to the FCA to talk about how we could bring the equivalent of Bitcoin, not necessarily Bitcoin, but cryptocurrencies into play. Obviously, it's a new area. Obviously, an area we've got to be careful with. We are working our way through it." Barclays has a mixed track record within the cryptocurrency community. It has an existing partnership with Circle, a financial application built on blockchain technology. At the same time, there have been numerous accusations about the bank refusing service to individuals whose accounts connected to or involved in cryptocurrency transactions. The new developments put Barclays in a positive light. Not really. Meanwhile, FCA doesn't seem to have many problems with the licensed financial institutions indulging in cryptocurrency trading or other related activities. The executive director of strategy at FCA, Chris Woodard, however, urges the institutions to exercise caution while dealing with digital currencies. The new development paves the way for mainstream acceptance and legalization of Bitcoin and other cryptocurrencies in the United Kingdom, like in Japan after it was legalized in 2017. Fuck legalization. Legalization implies that it's an illegal activity to begin with. That's like, there isn't any law that legalizes breathing. You just have to do it, right? Well, I don't believe there should be any license needed in order to create a cryptocurrency or deploy a cryptocurrency or steward a cryptocurrency or mine a cryptocurrency or even exchange cryptocurrencies between cryptocurrencies. I don't believe there should be any licensure for any of these activities. So the idea of making them quote-unquote legalized just means regulated to me. It just means that now we're going to start cutting certain constituencies out of certain sections of the community. You know, we're going to say, you know, if you can't afford a $5,000 application fee, then you can't afford to participate in this because clearly you don't have enough money to back up your investors if your coin tanks. You know what? That's not your responsibility. If your coin tanks, it's because people themselves have lost interest in it. Not because you weren't properly regulated. Now, if you do something that you fuck up, okay, and that causes people to lose confidence in you, what, is a regulator going to make them retain confidence in you? Is a regulator going to say, hey, you know, their license is still good. You know, they haven't intentionally defrauded anybody, so you got to still do business with them. Fuck that. That's the same situation we're in now with banks and credit card companies and various other legacy financial interests. And, you know, that's why cryptocurrencies even exist, is, you know, on top of the lack of regulatory burden, which a lot of people decide that that's what they want to concentrate on. They provide an alternative to people that are clearly operating gamed systems. I mean, yes, we have manipulation in our markets. There's no doubt about that. But if we didn't have manipulation in it, it would be because there was no interest in it. Manipulation just means that there's actually value there, and there are people that are trying to get the most of it. Now, is that to suggest that manipulation is good? No. But it is to suggest that manipulation is a factor of markets. And the best you can do is keep them open enough that people will be more incentivized to legitimately participate in them and possibly even legitimately pay taxes on them. If they're not being bogarted out of them, via licensure and other regulations. These systems were made to, or at least Bitcoin was made to not need trust. What good is a regulator in a system that doesn't need trust? I don't understand that. What's a regulator going to do, like to the quote-unquote Bitcoin network, to, quote, improve it? I mean, I don't see that they actually bring any additional value to legitimate, quote-unquote, legitimate markets, or how should I say it? Conventional markets, legacy markets. Those are fucking rife with manipulation too. I mean, has regulation stopped that? No. They're rife with fraud too. Has regulation stopped that? No. It just made your participation in that fraud more expensive because the banks are able to charge you more fees for it. And not even for doing that, for just to steal your money. Yeah. Anyway, kind of light on actual articles at the moment. It's just oh, wait a minute. That's actually something to talk about. Anyway, I'm going to do a short music break while I reassemble and get us back on track here. And we got some Meshuggah playing in the background, but that's not where I want to take things. Let's go ahead with some old school Metallica, and I think Tuesday will be a return to sanity. So let's go with "Welcome Home Sanitarium" here on Coin Metal. And that was Push Monkey with No Dumb Wrong. I guess what they're trying to say there with No Dumb Wrong is that mistakes are meant to teach us something. So it's not necessarily a stupid mistake, it's just a mistake. Unless, of course, you keep repeating it, then it's a stupid mistake. And then it's a dumb wrong. Anywho, I went ahead and dug a little bit past the old Twitter feed because I had a general direction of where I wanted to go today. And of course, when Twitter fails, Google is a close second in finding exactly what you wanted to talk about. And I try not to do that only because then you end up in kind of an echo chamber instead of just going with what comes, But I did kind of want to direct this one only because it's a little timely, And I try to be timely, if nothing else. So, this one, we've got another article here, and this one is on Coindesk.com, and it's written by Amy Castor, no penis. And this was written on June 20th of 2017. Too easy. Critics take aim at Ethereum token standard amid ICO boom. It's not hard to be taken aback by the amount of money consumers have been throwing at initial coin offerings lately. The new fundraising model allows developers to sell digital tokens to raise money for decentralized projects. Two recent events highlight why there may be cause for concern. Earlier this month, web browser startup Brave made $35 million in seconds selling its basic basic attention token BAT, and soon after a relative unknown called Bancor pulled in $150 million in hours, the largest ICO in history, despite claims about possibly sketchy code underlying the project. Like the majority of recent ICOs, these projects were both built on the Ethereum blockchain and they were both selling ERC20 tokens. ERC20 is a standard that allows a variety of tokens to interface with wallets, exchanges, and other smart contracts in a common way. Yet, while standards exist for good reasons, for good reason. Some believe when combined with a lack of regulation in this space, ERC-20 may be making it too easy for unscrupulous projects to get into the game. History lesson. ICOs are nothing new. The first was completed in July 2013 when Mastercoin, now Omni, raised over $600,000 in Bitcoin to fund an effort to build a protocol layer on top of the Bitcoin blockchain. The next big ICO was in April 2014 when the Ethereum project was announced. At that time, Ethereum sold 50 million Ether, its native currency, to raise $18 million in Bitcoin. Ethereum went live in July the following year. Once Ethereum was off and running, its developers came up with a way for those building decentralized apps on the network to create quote-unquote custom tokens to fund their projects. Investors could then buy these tokens with Ether and later trade them on exchanges. One of the more infamous crowd sales that come out of that was the DAO, short for Decentralized Autonomous Organization. The project, which launched in April 2016, quickly sold 150 million worth of tokens. 2 months later, due to a weakness in its smart contract code, the DAO was hacked to the tune of $50 million. As a result, the network was forked, and the money was eventually returned to the original investors. Despite that bump in the road, Ethereum recovered. And since then, ICO activity has gained steam. So far in 2017, blockchain entrepreneurs have raised $327 million through ICO offerings, not including the $150 million from Bancor, far exceeding traditional VC funding in the space over the same period. Over the same period. The huge spike in ICO activity coincides with the introduction of ERC-20. The question is, however, are these ERC-20 tokens really custom tokens at all? Copy and paste solution. Introduced in November 2015, ERC-20 spells out a set of rules that allow tokens to behave in a common and predictable way. Put simply, it means that any ERC-20 token will work with Ethereum wallets off the bat. And because exchanges already know how these tokens operate, they can easily integrate with them. This means, depending on any restrictions put on the tokens by the ICO, in many cases, those tokens can be traded immediately. Yet, while ERC-20 spells out the rules for how a token should operate, it does not include the code. Even so, that can easily be found in a public GitHub repository, such as OpenZeppelin. By copying and pasting that code, anyone with a modicum of programming experience can produce an ERC-20 token in minutes. Shlomi Zetzinger, a blockchain consultant and Ethereum coder who spoke to CoinDesk, demonstrates how it's done in his YouTube tutorials. Zetzinger feels most people do not realize how easy these tokens are to generate. Many ICO projects simply reuse this generic code, he said, while inputting variables like the token name, the token symbol, how many tokens one Ethereum will buy, total supply, and so on. The rest is simple too. When an investor wants to buy tokens during an ICO, they send Ether from any Ethereum wallet to the token's contract address. Those tokens can then be traded on any third-party exchange that agrees to support them. What about the app? But the problem is, while many of the ICO projects built on Ethereum have professional developer teams behind them, the vast majority do not, Zetzinger alleged. He claimed many projects are putting on a song and dance, giving investors the impression that the token they are selling is an integral part of a working or almost working smart contract. But this is often far from the truth, he said. And what buyers do not realize is, in most cases, what they are buying is nothing more than a number on a spreadsheet managed by that token's smart contract. In fact, after researching ICOs on Token Market, a website that tracks ICOs, Zeltzinger found the code underlying a substantial number of those contained nothing more than that spreadsheet. Arguing projects should be more upfront about what they are offering, he said. Every ICO that uses a simple ERC20 base code to raise funds needs to say out loud, "Listen, we are just raising money. Those tokens will not be used in the application. Maybe in the future we will find a way to make something cool with them, but they are not for the application right now." Likely, though, the situation will not change until more regulations and oversight kicks in. At least that is how Emin Günsür, a Cornell associate professor and researcher in cryptocurrencies and smart contracts, sees it. And while Syrer, my apologies on the pronunciation, Syrer agrees some projects are, quote, clear scams, he feels that others are honest attempts to tokenize or integrate or market some new function. To him, there is no one entity to blame. The Ethereum network and ERC20 are simply tools, much like the internet. But if things continue in the direction they are going, it may be the market is headed for a massive correction, or as Ethereum founder Vitalik Buterin tweeted, "There is no cure for bubbles except to let them run their course and pop," unfortunately. And that is true. Well, yeah. Minimal bad stuff in there as far as, like, spelling and whatnot. Altogether, a decent article. Thank you very much, Amy Castor. Yeah, it's fair to be concerned about that. I didn't know that about the ERC20 standard. I did know about the fact that they're like part and parceled on some chunk of Ethereum that they raise or whatever, but I don't know. I'm not terribly impressed with the idea of ICOs. Like I said, a lot of the white papers that I've read so far, they give me the impression that they're like scam coins that wouldn't have passed the scam coin test. Like if they were to try and launch like a legitimate altcoin on their own, you would take one look at it and be like, okay, so where's this thing based out of? And you see that it's like in the Virgin Islands or Switzerland or Luxembourg or somewhere outside of the jurisdiction of the United States. So that should throw up major red flags to you immediately. Okay? But those pass, or have been passing, because they've got the little tag ICO on them and they're attached to Ethereum. I mean, it works both ways. It attaches a little bit of legitimacy, but that's assuming that, of course, Ethereum itself is legitimate. And so far, it seems to be operating in a quote-unquote legitimate manner, although, of course, I wasn't a big fan of the peel back, the rollback, the split. But that's because I don't believe that's how cryptocurrency should operate. I think that when when you're offered the opportunity to get into a cryptocurrency, and there's certain things on the tag, and you read those things on the tag, and then they deviate radically from that, that you should just fucking bail on them. I mean, because obviously they're out to screw people. But with regard to Ethereum, I mean, at least they were very public about it. Although I've never really heard an acknowledgement of how much of their network they lost in the fork. Although I'm sure it's noted out there somewhere. Somebody has written a Reddit article about it or something, or some such. But I've never read an article about that. Like, how much of their network did they lose over 51%? Because it was obviously at least 51%, or they wouldn't have been able to fork the coin. So, how much of that community is actually keeping Ethereum alive? And you have to wonder, especially with ICOs dragging their fucking network down, And I haven't done any study on how many miners they have. Although they're from what I understand, there was a spike, or there has been, or there is a spike in interest in mining Ether, and that'll certainly cause their price to rebound a little bit. I think they're enough above expenses at this point that they're still profitable for those people to mine. I'm sure it'll recover over time. Assuming, of course, there aren't like multiple fucking ICO cascade shits happening on their fucking network. And I don't know. It's one of those things. Anyway, we're going to talk a little bit more about ICOs, and then I found a couple more articles about the crash, but I've got another article I want to get into right after this. But we're still on the subject of ICOs, so I want to go ahead and hash this one out. Why tech investors love ICOs and lawyers don't. And this is by Jeff John Roberts on June 25th, 2017. Here we go. When Brave, a privacy-focused internet browser company, decided to raise money this May, it could have gone a traditional route by borrowing money or selling equity to investors. Instead, it chose a third way, an initial coin offering, or ICO. Like an initial public offering, an ICO lets a firm raise capital from multiple sources. But rather than issuing shares of ownership, the offering company sells digital tokens, or quote coins, tokens, created through blockchain technology. In Brave's ICO, the startup raised $35 million from about 130 investors in less than a minute. Boosters believe that strategies like Brave could be the future of investing. A transformative approach to fundraising that enables consumers to benefit more directly from the popularity of new technologies than they would if they owned a traditional stock. Critics, meanwhile, fret that ICOs occupy a regulatory gray area that could leave investors vulnerable to fraud and land startups in legal trouble. And at this early stage in ICO history, both sides might be right. ICOs are among the big financial innovations to spring from blockchain technology, which uses revolutionary software and multiple computers to create tamper-proof record systems. Blockchain is central to the business models of most startups that use ICOs. Brave, for example, plans to use blockchain tokens to help its users earn money if they agree not to block off online ads. By distributing tokens in an ICO, a startup gives buyers early access to its technology to use however they see fit. If the service or product catches on, or in some cases before it even launches, If it generates a lot of buzz, the buyers can sell their tokens on secondary markets. The startup, meanwhile, raises money without conceding any control to private investors or venture capitalists and without the paperwork burdens of an equity IPO. That's a good thing, right? Perhaps the most famous ICO so far is that of Ethereum, which raised $18 million in 2014 by selling tokens that facilitate online contracts. Today, Ethereum-powered contracts are proliferating, and the tokens that had a market cap of $35 billion as of mid-June. Indeed, with speculators' appetites for blockchain rapidly expanding, the combined market cap of the world's cryptocurrencies has grown almost ninefold in the past 12 months to pass $100 billion. It's no surprise ICOs are having a moment. Renowned venture capitalists like Chris Dixon of Andreessen Horowitz and Fred Wilson of Union Square Ventures now tout ICOs as a form of corporate financing. Even companies that are not blockchain-centric are getting in on the action. Messaging service Kik, founded in 2009, plans to conduct an ICO this year in hopes that tokens will spur more person-to-person payments and gaming on its platform. According to research firm Smith & Crown, dozens of firms have already completed ICOs this year, with dozens more to come. The 30 that reported their gains have raised about $540 million. So what do regulators have to say about this brave new world? Right now, nothing. And that could be a problem for investors and startups alike. In a traditional IPO, a company can't sell shares unless it gets approval from the Securities and Exchange Commission, which means disclosing extensive details about business prospects and potential risks. For ICOs, there are no such requirements yet, and that could make them prone to abuse. Hey, you know what, dude? Caveat emptor. You've got legitimate markets, you've got markets that are regulated by the Securities and Exchange Commission, and if you want a mommy and daddy to hold your fucking hand, trade on those. Continuing. While no fraud investigations of ICOs have come to light, blockchain fans frequently warn one another about dubious offerings in online discussion groups. One snide slide deck in wide circulation is dubbed Ponzi ICO, and some companies have been able to issue tokens even though their business models are long shots at best. Jeff Garzik, a leading figure in the blockchain community who runs a consultancy called Block, sees ICOs as, quote, transformative, but remains wary. 99% of these ICOs will be garbage, he says. It's like penny stocks, but with less regulation. And that's fine. Even though and that's fine was my addition. Even the most legitimate and fiscally sound ICOs pose a potential threat for issuers. Coins or tokens that can look a lot like traditional securities because they enable companies to take an investor's cash while holding out the potential for profit. And selling securities without SEC approval violates federal law. In the future, token sales won't be done in the same way as today because of regulatory constraints. That's bullshit, says Marco Santori, a digital currency lawyer with the firm Cooley. If regulators eventually determine that tokens are securities, Santori says, the SEC and Internal Revenue Service could impose sanctions on issuers. Such a decision could also make it easier for investors to sue startups if their tokens become worthless. No, they can't. You know there's a high potential for abuse in unregulated markets. Do not risk what you do not intend to lose. If you do not intend to lose it, do not invest it. That's all I'm going to say on the matter. Anyway, continuing. Attorneys are now helping startups structure their ICOs to stay on regulators' good side. Lee Schneider, a securities lawyer with Debevoise and Plimpton, who also hosts a fintech podcast, collaborated with the digital currency exchange Coinbase on best practices for ICOs. Schneider prefers to call them token launches, and his advice offers good rules of thumb for would-be buyers too. The best token exchange involved predictable pricing, bullshit. A clear relationship between demand for tokens and their price, bullshit. Issuers should be transparent about sharing the software code underlying the tokens, absolutely. Perhaps most noteworthy, Schneider says ICO candidates shouldn't market tokens as the equivalent of an investment, absolutely. They should pitch buyers on what the tokens can do and not on what they could be worth. The bottom line, if a startup advertises its coins as something you can flip to get rich, its ICO is more likely to be garbage than transformative. And a version of this article appears in July 1st. How's that? That's weird. Check this out. A version of this article appears in July 1st, 2017 issue of Fortune with the headline, Investors Seek Sweet Coin. And this article was on Fortune.com. And the title of it was Why Investors Love ICOs and Lawyers Don't, written by Jeff John Roberts. And at least Jeff got most of his spelling errors and grammar issues out of this article before releasing it, which I appreciate. Anyway, yeah, more of what we've been talking about. You know, buyer beware, man. But you know what? If somebody is guaranteeing you some like aspect of demand or level of interest or level of necessity of use or any of that other bullshit in association with ICOs, they are lying to you. That's about it. They're lying to you. I mean, you can't expect that a token is going to trade at the same rate today, the same exchange rate today, with Ethereum or any other coin that's exposed to the open market. Because if you do that, then you go up and down with them. You know, and your coin might as well not exist. You might as well just call it Ethereum. You know. Anyway, yeah, I think ICOs are great in that they don't have regulation. And I can see some potential for good uses of them. But the thing is you have to be legitimate with the code. And so I don't know that basing it on Ethereum itself would be such a great thing, only because we've seen a lot of market concessions for fuck-ups. Fuck-ups that other coins have just endured and walked on through. And that doesn't give me additional confidence. The fact that mommy and daddy are going to clean up the spilled milk, that doesn't give me confidence in your fucking project, dude. Just because GDAX is willing to take it in the shorts for you, that doesn't give me confidence in your coin. That just means that there's some different level of regulation. Because, I mean, I'm sure that GDAX isn't going to do that for every coin that fucks up. So, I mean, really. I mean, it's a vote of confidence in the platform and whatnot, but it stinks of that too big to fail bullshit that we're trying to escape in traditional markets. I mean, that's why a lot of us even bother to come in here, is because there's no such guarantee here. You know, it's kind of nice. You know, I mean, big whoop-de-doo, you're here on your own dime, but you're here on your own dime. And there's something to be said for that, really. Anyway, I want to go ahead and throw down a little bit of music here. Some Static X, Cannibal, here on Coin Metal. And that was a Shogun named Marcus, off of Transnational Speedway by Clutch. Anyway, enough of the Ethereum business and the... I wouldn't call it fudding. I mean, in all honesty, I don't think we've been fudding today. I think the concerns that we've raised, they're legitimate, and in the light of recent events, they're worth consideration. Most certainly. In any case, I saw this, and this is one of those how should I say it? One of those articles that makes me wonder if some of those in the mainstream actually understand what they're talking about. And, yeah. So anyway, this one is on Forbes.com. It was written on June 26, 2017. It was written by Jason Bloomberg, and there is a picture, so we can confirm Mr. Bloomberg does in fact have a penis. Alright, and just to give you a little background on Mr. Bloomberg, because he was so thoughtful as to include it here. Jason Bloomberg is president of Intellex and is the leading industry analyst and global... Oh, Jesus fucking Christ, you've got to be fucking kidding me. Sorry. If that doesn't stay muted, I'm going to get off of this fucking website. Jason Bloomberg is president of Intellex and is the leading industry analyst and globally recognized expert on agile digital transformation. He writes and speaks on how today's disruptive enterprise technology trends support the digital professionals' business transformation goals. In addition to writing for Forbes, he writes his bi-weekly newsletter, The Cortex, and several contributed blogs. He also helps technology vendors and service providers communicate their digital transformation stories. His latest book is The Agile Architecture Revolution, Wiley 2013. Alright. So now that we're through that, we've established Mr. Bloomberg's credentials, or at least the ones he's chosen to give us. As the market value of a single... I guess I should preface this with the title again. What is Bitcoin's elusive intrinsic value? As the market value of a single Bitcoin comes down off of its lofty all-time maximum of over $2,800 to a still bubbly $2,500 or so, aficionados and skeptics alike wonder whether the Bitcoin speculative bubble is finally popping, or whether the recent downturn is simply a profit-taking opportunity and those fuckers... You motherfuckers. I guess I'm just going to have to be really fast about reading this fucking article, because this shit doesn't want to pause and doesn't want to stay off. You know what? I'm gonna... God damn it. I'm not going to disable it on there. Hopefully that'll keep that shit blocked without blocking me. Anyway... As market value, lofty, blah, 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 let's go to profit-taking. Okay. Whether the recent downturn is simply a profit-taking opportunity on the road to even loftier heights. And speculative bubble, it certainly is, as a non-negotiable software-constrained supply runs headlong into greater fool demand, as even greater fools displace the ones before. All participants, foolish or not, increase their focus on the central question of Bitcoin. Why does Bitcoin have any value at all? Adam Smith's invisible hand of supply and demand explain the market value of Bitcoin, to be sure, as market value is simply what someone is willing to pay, and plenty of fools are so willing. Strip away the drivers of extrinsic value, namely its greater fool demand and its constrained supply. However, what remains? The asset's intrinsic value. Just as gold would retain its luster, malleability, and resistance to tarnishing, thus making it useful for numerous manufacturing and jewelry purposes regardless of its scarcity, one wonders what intrinsic value Bitcoin holds. You would think the answer would be obvious, but instead it's remarkably elusive. Never before in the history of commerce has a speculative bubble developed around an asset that had no clear intrinsic value. Even tulips, the very symbol of a speculative bubble, are flowers of remarkable beauty. Where then lies the intrinsic value of Bitcoin? Bitcoin's mysterious missing intrinsic value. Plenty of people, both aficionados as well as skeptics, question whether Bitcoin has any intrinsic value whatsoever. The question is, I do not understand where the backing of Bitcoin is coming from, says Alan Greenspan, former chairman of the Federal Reserve. You have to really stretch your imagination to infer what the intrinsic value of Bitcoin is. I haven't been able to do it. And just a side note, that's because Mr. Greenspan is used to dealing in debt vehicles. Continuing. Such consternation appears on all sides of the political spectrum. There is no intrinsic value, states Henry Blodgett, founder, CEO, and editor of Business Insider on CNBC's Squawk Alley. If anybody is persuading you that it should somehow be related to some GDP or gold, put down the Kool-Aid and back away. Absolutely. Correct on that one. And then there's Paul Krug, writing for the New York Times, quote, to be successful, money must be both a medium of exchange and a reasonably stable store of value. And it remains completely unclear why Bitcoin should be a stable store of value. Krugman writes, I have had and am continuing to have a dialogue with smart technologists who are very high on Bitcoin. But when I try to get them to explain to me why Bitcoin is a reliable store of value, they always seem to come back with explanations about how it's a terrific medium of exchange. Even if I buy this, which I don't entirely, it doesn't solve my problem. What about Bitcoin's utility? In fact, many people consider Bitcoin's utility to be the source of its intrinsic value. A reasonable conclusion on first glance, as many assets' intrinsic value depends on the asset's utility, including gold. Some writers even go so far as to say that Bitcoin's only intrinsic value is its utility. Quote, Bitcoin's utility as a store of value is dependent on its utility as a medium of exchange, writes John Kohler, a freelance web developer in Investopedia. Quote, we base this in turn on the assumption that for something to be used as a store of value, it needs to have some intrinsic value. And if Bitcoin does not achieve success as a medium of exchange, it will have no practical utility and thus no intrinsic value and won't be appealing as a store of value. Muddying these waters is the fact that many people confuse Bitcoin's utility with its political value. Mark Rees, senior systems engineer at Intermountain Healthcare, writing for Bitcoin Magazine, for example, listed Bitcoin's transparency, programmability, use of multiple signatures, and a number of other features of Bitcoin that make it usable. In addition, Rees lists characteristics that may offer political value, like its transcendence of borders, independence of banking laws, and its ability to, quote, upend centuries-old money monopolies. This radical libertarian context for Bitcoin, in fact, has led many of the cryptocurrency's fans down a rat hole of confusion. The reason? The libertarian belief that money requires a physical basis of value, which is why so many libertarians want to dissolve the Federal Reserve and return to the gold standard. Should we ask the libertarians? Jack G. Shorebird, writing for Tough Nickel, begins by quoting Ayn Rand. Money cannot function as money, i.e. a medium of exchange, unless it's backed by actual unconsumed goods. He continues, cryptocurrencies do not require an intrinsic value. They are not gold in the rough. What is important is that the cryptocurrency, like a check, is backed by an unconsumed good. The conclusion to this questionable line of reasoning is that Bitcoin cannot function as money. Quote, given this definition, cryptocurrency, with few exceptions, is not functional money yet, Shorebird continues. But neither are dollar bills or euros. Dollars, for example, are backed by nothing. Few people outside the community of radical libertarians would claim that fiat currencies like dollars or euros aren't money. In fact, such currencies are backed by the, quote, full faith and credit, what the fuck is that, of countries that issue them, backing that Bitcoin lacks by design. Without such banking, we're left once again with the question of Bitcoin's intrinsic value. It's not simple. The dollar has intrinsic value because you need dollars to pay taxes in the United States, explains Joe Weisenthal, writing for Business Insider. Gold has real value because it's shiny and can be used for jewelry. But what about Bitcoin? If you ask Bitcoin believers why a Bitcoin is worth anything at all, they will tell you about how amazing the technology is, and how it's programmable, and how cryptography and pseudo-anonymity are so great. But none of these are really satisfying answers. It's because you don't understand what the utility of those things actually is. Beyond Bitcoin's utility, the reason Bitcoin's utility as a cryptocurrency is an unsatisfying explanation of its intrinsic value is because for all other types of assets, intrinsic value goes beyond the asset's use as a medium of exchange. After all, the reason gold has served so well as money throughout history is the combination of both its scarcity as well as its intrinsic value outside of its use as money. Bitcoin lacks such utility. While some people theorize that cryptocurrencies like Bitcoin don't actually require intrinsic value, others are more realistic. The supply of Bitcoin is fixed, and there is no other use for it besides as a currency, explains Sean Lynch, site reliability manager at Google. Writing for Underground Economist, quote, merchants will go from taking one coin for a year of porn to not taking Bitcoin at all, and a bunch of people will be left with worthless Bitcoin. Yeah, he's full of shit. The notion that cryptocurrency doesn't need intrinsic value is nonsense, because market value always depends in part upon intrinsic value. Currencies to be exchangeable have to be backed by something, Greenspan points out. Without intrinsic value, nobody would have assigned Bitcoin a value in the first place. Yeah, whatever. The missing piece of the puzzle. The missing piece of the puzzle, the piece that both Bitcoin fans as well as detractors have missed, is the ability to mine Bitcoin. Because in theory, anyone can put in the effort to create new Bitcoin by processing Bitcoin transactions. It is possible to profit on Bitcoin outside of its use as a medium of exchange. This fact, combined with its enforced scarcity, enable Bitcoin to become such a medium and thus have value. Because you, yourself, can actually expend electricity and hardware and so on to participate in it. In fact, the Bitcoin infrastructure is intentionally set up to reward miners. If more miners attempt to create Bitcoin, then it automatically becomes more difficult to profit from the process. Likewise, if fewer miners make the attempt, then it becomes easier. Then it becomes easier to make money that way. A Bitcoin's intrinsic value, therefore, is the representation of the effort it takes to mine it. However, figuring out this value is a complex task. There's the straightforward cost-benefit analysis, how much it will cost you to set up your mining gear, pay for electricity, etc. Many people seek to make money this way, but you could crunch all the numbers to ensure that you'll mine enough Bitcoin to more than cover your costs and still not make any money mining. That's very rare. The problem by design, as more Bitcoins are mined, the harder it becomes to mine them. Only those with specialized high-power machinery are able to profitably extract Bitcoins nowadays, explains Jordan Tuender, founder and CEO at Buy Bitcoin Worldwide. While mining is still technically possible for anyone, those with underpowered setups will find more money is spent on electricity than is generated through mining. That's why you hodl. Over time, therefore, the pool of successful miners will continue to shrink, leaving only large industrial operators with unusually low costs, typically due to government subsidies. The problem with Bitcoin's intrinsic value. As this pool shrinks furthermore, another problem arises, the 51% problem. The 51% problem derives from Bitcoin's essential decentralization. If one party, say Chinese government subsidized and government-controlled miners, acting in concert, controls 51% of mining capacity, they can change Bitcoin's rules as they like. The risk inherent in this situation goes well beyond simply the collapse of Bitcoin, since Bitcoin's intrinsic value is tied to the ability to mine it. Any party in control of Bitcoin can also change Bitcoin's intrinsic value however they like. Oh, and as a sidebar on this, I just wanted to add that I don't recall which BIP it is, but it's in association with segregated witness. There's a thing in there that actually changes that, what determines that the 51% problem. It changes it to a problem that cuts down to 35%, because the 75 the consensus protocol has dropped down to 75%, and users, i.e. the community, i.e. LN node operators, i.e. exchanges, i.e. banks, anybody interacting directly with the Bitcoin network via their Lightning network, will be able to change the consensus rules if they get 75%. The threshold is reduced from 95% down to 75%, I believe it is, and it's based on users instead of miners. Something to consider at this point in this conversation. The risk inherent in this situation goes well beyond simply the collapse of Bitcoin, since Bitcoin's intrinsic value, tied to the ability to mine it, any party in control of Bitcoin can also change Bitcoin's intrinsic value however they like. Never before in the history of civilization has this happened, where cornering the market on a commodity means gaining the power over its intrinsic value. Before such time as the 51% event occurs, all we have to worry about is the popping of the speculative bubble. Long term, however, the risks underlying Bitcoin are far greater and more difficult to understand. In the final analysis, we may find the mining metaphor to be comforting, but in reality it is dangerously misleading. Gold miners cannot fundamentally change the nature of gold itself, but Bitcoin miners potentially can do just that, and it's just a matter of time until they will. And let's see, and that was the end of it. And so, in all honesty, there's a lot of untruth in this. They're like partial truths, but not real truths. The intrinsic value of Bitcoin in my mind anyway, is defined by your willingness to participate in it. You know, if you believe in it enough to mine it, i.e. participate in it, you're determining its intrinsic value. Because when you sell it back out to the market, that'll define how you price it. You know, you may be kind of shortchanging yourself, but the market is there to kind of correct you, you know? So yeah, I think the old ideas of what intrinsic value means, you know, I think it's going to be kind of shifted in a digital way. Like with gold, the value of it is the fact that somebody was willing to actually mine it. You know, because it doesn't come above ground until somebody actually mines it, right? Then you can hold it in your hand and you can own it, right? But until that point, it's just some media at the bottom of a river or under several feet of dirt in an old riverbed or in the ocean or some such. But for the most part, effort has to be expended in which to acquire gold. And the same metaphor is brought to Bitcoin via the mining process. So, you know, the fact that the Bitcoin exists kind of it exemplifies the fact that somebody was willing to dedicate the hardware, the electricity, and the bandwidth that was required in order to mine it. You know, this is somebody putting the debt obligation on the future to valuate it. Whereas the Federal Reserve doesn't operate in the same way. They define their valuation until they issue their coins out into the market, and then the rest of the market adjusts to the relative availability of liquidity in that particular currency. That's one of the dangers of Ethereum tokens, is that, and that was indicated in one of the articles that we read the other day, that some of the ICOs have the ability to issue new tokens at will. You know, and they supposedly counterbalance it out with a variety of other tokens and other mechanisms. You can't account for the market at large. You can write whatever the fuck you want on your goddamn white paper. You can cajole your investors however you want, but you cannot account for the wild market. You just can't. It's the same reason why you can't trust the fact that just because your fucking project works on a test net, that it's going to work out in the wild. You know, you have to have a community supporting it. In any case, I want to break into a brief music interlude, and we will get back onto one last article, and we will close out this episode. So for that, we're going to go ahead and throw in Conquering here by Crowbar here on Coin Metal. And that was Fear Factory with Descent. And yeah, we've had our little bit of descent over this last week, or weekend, or yeah, end of the week, over the weekend. But I believe that overall we'll continue to have an upward trajectory. If you look at the longer term charts on Ethereum and Bitcoin, there's, and Verge for that matter, I think that there's plenty of room for upward mobility, and I think that there's still enough market sentiment out there on the side of cryptocurrencies and the opportunities they represent. I think there's enough positive sentiment out there that we'll get up and over this, just like we've done with every other bump in the road, and we'll continue on. It'll just be Bitcoin on. You know, we can be afraid for the moment or whatever. I mean, but in the longer term, I think that, like I said, I think there's just too much other shit coming on the horizon. I think that I don't think this is over by a long shot. I think that we just had a dip. We had some people taking some profit. We had some FUD. We had some goofy occurrences. And, it's going to happen. It's happened before. It's going to happen again. But I did hear I'm starting to hear some little whispers. And they're starting to concern me. And they're not even in crypto either. That's the more concerning part. And I think it's indicative of why there's increased interest in regulating cryptocurrencies now. Because I've been hearing little whispers so far, but I'm sure they'll get a little louder over time, of QE4. And I don't know if you guys remember quantitative easing or not, but I've suggested many, many, many times, and I still stick with this, that when you go back to the last run-up in Bitcoin, and I don't mean the one to $3,000, I mean the one before that, the one that stood as a space needle on that fucking chart for so long before it was joined by the most recent ones. That one, if you look at the period leading up to it, you saw people buying anything collectible and the prices of all those things going up. And it was because the Federal Reserve was just pissing liquidity out the window at a rate of $100 billion a month. And that's just what they were counting on the front end. You can assure yourself that they were probably printing more on the back end. But the point being that while they were doing QE1, and it went like clockwork too. It's like at QE1 we were at 220, or I think the first run up it was about 220. Then in QE2, oh no, actually it started earlier than that. QE1 I think we were at like 67. Then QE2 we were at like 220. And then QE3 we were about, I want to say, somewhere between 400 and 600. And then they said they were going to go QE forever. And that it went Space Needle. Okay? And that's what happened back then. You know, and a lot of people just like disregard this association with fiat currencies and what that does to the exchange rate between fiat currencies and Bitcoin and other cryptocurrencies. I don't know why they disregard it. I don't know why they don't talk about it, but they don't talk about it. It's like it doesn't exist. It's like, you know, I recently bought a package of sausages, and they're the little patty sausages, right? And I remember a long time ago when I first bought these Brown and Serve little sausages. They were about, I don't know, I want to say they were close to a half-inch thick, and they were about 6, maybe 7 inches around, maybe a little bit long, maybe a little bit bigger around, but they're quite large. The last time that I bought them, I opened the package and I shit you not, they were the size of Oreos. Now, Max Kaiser characterized this effect as shrinkflation. All right, well, if it's having that effect on, I mean, if the prices are changing so much for manufacturers that they have to reduce the volume of their products that much, there's a lot more fucking turmoil going on out there than you're being led to believe. I mean, seriously, I was shocked. These things were a little bit bigger around. Actually, they were about the size of the average. I don't know, a little bit below average chocolate chip cookie, a sausage, and I mean about the same thickness and everything. I was looking at it, I'm like, what the fuck is this thing? It looks like a goddamn dog treat. It's not a sausage, it's a dog treat. Anyway, the point I'm getting to on that is that those same effects happen with Bitcoin. Okay? That your dollar will buy less Bitcoin tomorrow than it does today. And that's because while on the Bitcoin side, they're cranking out, what is it now, 12.5 every 10 minutes, right? Well, on the fiat side, they're printing the dollars faster than that. A lot faster. And during quantitative easing, they double the printing capacity and just shit that goddamn liquidity out into the market. So if quantitative easing 4 happens, you can anticipate a corresponding spike in all cryptocurrencies when exchanged in Federal Reserve notes. There's your deep secret fucking economic news with regard to cryptocurrencies. You heard it here first. QE4 happens, we're going fucking moon. And that's assuming, of course, that they don't manage to pervert Bitcoin with the segregated witness bullshit and fuck us all up that way. Or, I don't know, start legally issuing fucking ETFs, and then we're in the same position of gold, where even though it does have a quote-unquote intrinsic value, we have no idea who owns it, because there's fucking 8 billion ETFs or whatever, or other obligations on it by, a million fucking hands to every ounce of gold. And every other ounce of gold that's ever going to be mined and shit like that. I mean, the gold market has been gamed very, very hard. And it's because, to some extent, there is some sort of question between expected production and what is actually extracted out of the ground. And that's why you have ETFs and all that, and it's to level out the gold price to make up for dips in actual supply. Well, with Bitcoin, you don't have that problem, in that you know how many they're going to be. There are only ever going to be 21 million of them as of this date, and I don't expect that will ever change. But because of that, we have a lot less speculation as to the available volume. We're actually able to determine at any point what the available volume actually is. And so, it takes a lot of that bullshit speculation out. And in my mind, the effort to create payment channels and all that, fuck all that shit. They're gonna be using that to overpromise your fucking Bitcoin to other people. I mean, you can quote me on that. Later on, they will be using payment channels to overextend the obligations on your Bitcoin before it actually touches back to the blockchain. And I think that the Lightning Network itself talks about, the paperwork itself talks about trusted nodes. Are there trusted nodes out there in the Bitcoin network that I'm unaware of? I mean, what the fuck is a trusted node? Is that a node owned by a party that is registered it, that has a license to run that node? Oh, maybe. Shit. People are fucking with fire with that stuff. I'm telling you. Anyway, I think I'm out of articles for the night. Man, I just used them all up. The scare of what's going on out there was more than enough to chew on for this evening. I mean, there's been more than enough of it out there. And we touched on some of the lesser acknowledged aspects, but I really think the one that I mentioned there, the connection with Federal Reserve notes and other fiat currencies, they cannot be overstated. It cannot be overstated. You have to keep it in mind when you're looking at that fucking exchange rate. Otherwise, you're going to end up missing the mark as to why things are happening the way they are. You know, it's like I was saying the other day how the previous spike or drop in Bitcoin recently had more to do with the Federal Reserve's change of policy on interest rates than anything else that was happening in crypto. Because that's exactly what happened with us the first time that the Fed bumped the interest rate. Is we slowed down, we went sideways for a little bit, we actually dipped, and then we came back up again. And then we started running off to the races, and here we are again. Federal Reserve says, oh, we're going to bump the interest rate by 0.25 points, or 25 points, and and we plan to do that one more time by the end of the year. Well, what other effect did you anticipate it was going to have? So, conversely, when the Federal Reserve starts talking about quantitative easing 4 to get us out of the recession that we're kind of slipping into, according to the economists, we're going to be right back to that moon launch cycle. And, And I expect that to happen whether or not segregated witness ever goes through, just because I believe in Bitcoin, and there's not going to be more than 21 million of them. So, as long as that doesn't change, I think we're just fine. Anyway, I want to go ahead and close out this episode. We're getting down to the last 6 minutes. I'd like to remind you again, these episodes are posted without the metal up on my YouTube channel. For those of you who don't necessarily like it, but do like to hear the stuff about cryptocurrencies, we have that available for you. But until then, I will be back on Wednesday at 8 p.m. Pacific Standard Time. And until then, you can find me in the Verge Currency IRC chat room. It's just Verge. And you can also find me on Twitter, DJERock23, and also on Facebook and YouTube under the name Frank Dashwood. And so, closing as we always do, until then, I want you all to trade safe. Do your homework! And watch out for your bunghole, because nobody else will do it for you. Anyway, I'm going to go ahead and close out. Our last dance for the evening will be Megadeth. Holy Wars, the punishment due. Thanks for listening. You all have an excellent evening.